Hey there! We're so excited to share today's video with you on our channel. When people hear the word stock market, they often picture Wall Street traders shouting buy and sell orders, giant digital tickers flashing numbers, or apps where anyone can purchase shares with a simple swipe. But few ever stop to wonder where it all began. How did we go from merchants in Europe trading spices and cloth to a multi-trillion-dollar global financial system that impacts nearly every aspect of our daily lives? The history of the stock market is a story of risk, reward, innovation, crashes, resilience, and constant transformation. And while the details may seem complicated, the basic principles are surprisingly simple and timeless. Let's take a journey back in time and see how it all started, how it evolved, and what lessons history has taught us about investing in human behavior. The origins of the stock market. The roots of the stock market can be traced back to the early 1600s in the Netherlands. At that time, international trade was booming, but it came with enormous risks. Sending a ship across the ocean was incredibly expensive, and a single storm, pirate attack, or failed expedition could wipe out years of savings for one merchant. Merchants needed a way to spread risk, and that's where the revolutionary idea of shares was born. Instead of one person bearing the entire burden of financing a voyage, merchants sold small pieces of ownership, or shares, to multiple investors. Each investor contributed money toward the voyage, and in return, they would receive a portion of the profits if the journey was successful. If it failed, their loss was limited to the size of their investment. In 1602, this concept became formalized with the creation of the Amsterdam Stock Exchange, widely considered the first true stock market. The Dutch East India Company, one of the most powerful corporations of its time, became the first company to issue stock. Investors could now buy, hold, and sell these shares, creating the first secondary market for trading ownership. This system changed everything. Instead of wealth being tied up in land or gold, ordinary merchants and citizens could now invest in businesses and share in their success. The foundations of capitalism as we know it today were being built in that bustling trading hall in Amsterdam. Expansion and growth. The idea quickly spread across Europe. By the late 1600s, London was buzzing with commercial activity. Coffee houses became popular meeting places for merchants, investors, and speculators. Over time, these informal gatherings transformed into organized exchanges, leading to the establishment of the London Stock Exchange in the 1800s. Meanwhile, across the Atlantic, the seeds of what would become Wall Street were being planted. In 1792, under a buttonwood tree in New York City, 24 brokers signed what became known as the Buttonwood Agreement. This agreement set the foundation for the New York Stock Exchange, which would grow into the most influential stock market in the world. Back then, trading was personal and chaotic. Deals were struck with handshakes, paper certificates changed hands, and information spread slowly through word of mouth or newspapers. There were no apps, no instant price updates, just raw human interaction and speculation. Yet the core principle was still the same. Companies raised money by selling ownership shares, and investors hoped to profit by betting on their success. How the stock market works today. Fast forward to today, and the stock market looks almost unrecognizable compared to its humble beginnings. Gone are the paper certificates and crowded trading floors filled with shouting brokers. Most trading now happens electronically, in fractions of a second, powered by algorithms and digital platforms. Instead of needing to be a wealthy merchant, almost anyone can invest today. Mobile apps and online brokerages allow people to buy shares with as little as a few dollars. Millions of transactions occur every day, moving billions of dollars across global markets. Yet, despite all the technology, the principle has not changed. Companies issue shares to raise money for expansion, innovation, or paying off debt. Investors buy those shares, hoping the value will increase or that the company will pay dividends. The stock market remains the meeting place where supply and demand set the price. The mechanics have evolved, but the essence of the stock market, sharing risk and reward through ownership, remains as it was centuries ago. No story of the stock market would be complete without talking about its darker side, the crashes. While markets are engines of wealth creation, they are also prone to bubbles, panics, and sudden collapses. One of the most infamous crashes happened in 1929. During the roaring 1920s, stock prices soared as optimism spread. Many people bought stocks with borrowed money, confident prices would only rise. But when confidence faltered, panic set in. In October 1929, the market collapsed, wiping out fortunes overnight. This crash triggered the Great Depression, a global economic disaster that lasted for years and changed how governments and regulators approached financial markets. Another devastating event was the 2008 financial crisis. Fueled by risky lending practices and a housing bubble, banks and investors piled into mortgage-backed securities they barely understood. When homeowners began defaulting on loans, the system unraveled, leading to a global financial meltdown. Trillions in wealth evaporated, major banks collapsed, and millions lost jobs and homes. More recently, in 2020, the COVID-19 pandemic sparked a sudden crash as fear gripped the world. Markets dropped sharply, but this time, recovery came surprisingly fast as governments and central banks stepped in with massive stimulus packages. These crashes highlight a recurring theme. Markets are driven not only by economics but also by human emotion, fear, greed, optimism, and panic. Recovery and resilience. While crashes can be terrifying, one remarkable feature of the stock market is its resilience. Despite devastating collapses, the market has always managed to recover and grow over the long term. After the Great Depression, it took years, but markets rebounded as economies rebuilt. Following the 2008 crisis, global markets eventually surged to new highs as innovation in technology, healthcare, and energy pushed businesses forward. Even the COVID-19 shock, which initially caused panic, turned into one of the fastest recoveries in market history. Why does this happen? Because markets ultimately reflect human innovation and economic growth. Businesses find new ways to create value, economies expand, and wealth is generated. While short-term crashes are painful, history shows that the long-term trend of the stock market is upward. This is why many financial experts stress the importance of patience and long-term investing. Short-term fluctuations are inevitable, but resilience is built into the system. Then versus now. When we step back, the contrast between then and now is incredible. In the 1600s, merchants risked everything to fund a single voyage across treacherous seas. Today, an ordinary person can pull out a smartphone and buy shares in some of the world's biggest companies within seconds. The tools and technology have evolved beyond imagination, but the essence remains: pooling resources, spreading risk, and sharing in potential rewards. Whether in Amsterdam centuries ago or on Wall Street today, the stock market has always been about connecting those who need capital with those who have it, and rewarding both sides when ventures succeed. Why the stock market matters. So, what can we take away from this journey through history? The stock market is not just a place for traders, bankers, or financial experts. It is a reflection of human ambition, risk-taking, and the constant push to build something greater. It has experienced incredible highs and devastating lows, but through it all, it has remained a cornerstone of modern economies. Every innovation, from railroads to the internet, was funded in part by people willing to invest in the future through the stock market. And here's the key: while markets are unpredictable in the short run, they reward patience and resilience over the long term. That's why so many people see investing not as gambling, but as a way to participate in the growth of human progress itself. So next time you hear the word stock market, don't just think of flashing tickers or busy trading floors. Think of the Dutch merchants in Amsterdam, the brokers under the buttonwood tree, the resilience after each crash, and the endless cycle of risk and reward that has carried us from wooden ships to digital trading apps. The history of the stock market is the history of people daring to take chances, pooling resources, and building futures. And whether you're an investor or simply curious, understanding this history helps you see why the stock market is not just about money, it's about the story of human progress. Thanks for joining me on this journey. If you enjoyed learning about the stock market's fascinating past and how it connects to the present, don't forget to like this video, subscribe for more clear and simple explainers, and share your thoughts in the comments. What part of stock market history surprised you the most? Until next time, remember this: the market may rise and fall, but knowledge, patience, and perspective are the true investments that never lose value.